Hi everyone. I realized this morning, and especially after helping one of your classmates this afternoon, and then again having a question come up from yet another classmate via email, that probably many of you, if not all of you, could be confused right now about what goes on page 1 of the partnership tax return that you've been asked to prepare for me this week. And so I wanted to discuss with you the difference between a partnership's or a corporation's book income statement and its tax income statement. And by the way, if we had not scrambled the chapters, if we had actually been assigned the corporate chapters before the partnership chapters, I probably would not have to be doing this lecture right now. But because in one of the corporate chapters, I think it's chapter 3, it actually explains book tax differences. So first of all, a company has a set of books and records, and they develop those books and records from transactions that happen during the year. So for instance, when they buy a fixed asset, they pay cash for that fixed asset. So the journal entry to book that fixed asset, in other words, to put it on the balance sheet, is to debit fixed asset and credit cash. So if they bought a desk, or in this case, if they bought sign displays and bookcases, or whatever it's called in the, let's see, what's it called in the, they bought signs and display cases for $17,300 this year. And you know that because it says under number 4, Aspen Ridge expensed $17,300 of signs and display cases for tax purposes. Now, I'll explain to you what that means from a tax perspective in a minute. But we also know that if, for tax purposes, they're expensing that purchase, then they must have actually bought those signs and display cases during the year. So to book that, to put that purchase on the books, they would debit fixed assets, or they would have several fixed asset accounts sitting in their GL. One of them would be furniture and fixtures, one would be machinery and equipment, another might be computers, another might be software. So most companies will set up several different balance sheet asset accounts for their fixed assets because first of all, they're depreciating them at different rates. So some, like the furniture and fixtures, they might depreciate straight line over 7 years, but the computers and the other machinery and equipment, they might be depreciating straight line over 5 years. So they normally keep them in separate accounts so that they can track the additions and deletions of those fixed assets over a period of time. And so we know that they bought fixed assets equal to $17,300 during the year. And so the entry to record that is debit. I'm going to call signs and display cases, actually, I'm going to assume that that's furniture and fixtures. So I'm going to say they debited furniture and fixtures and they credited cash for $17,300. So now on their books, they have $17,300 more of fixed assets in the current year than they did in the prior year. For book purposes, they're going to depreciate those straight line. That's GAAP. That under generally accepted accounting principles, i.e. GAAP, you normally depreciate assets straight line. So, and normally it's done over 5 years. I see most assets being depreciated over 5 years for just things like furniture and fixtures and equipment. But they'll still keep them in separate accounts just to kind of segregate them, and also for inventory purposes. So that's what they're doing for book purposes. And if you were to divide 17, assuming that they bought those signs at the beginning of the year and they're depreciating them over 5 years, 17,000 over 5 is like 3,000 something, okay? It's close to $4,000. Let's just say that it's 4,000, okay? So included in this book income statement, which was what this is right here, is 4,550 depreciation. Now that's expense on the books, and I just told you that those signs they bought this year are probably going to be depreciated around to the tune of around 4,000 or 3,900 during the year. So there's another $1,000 of depreciation that they must have taken for book purposes on prior year assets. In other words, assets that were added that were purchased in prior years. So that's what that book depreciation is comprised of. It's comprised of depreciation on prior year assets purchased and also on the current year assets purchased, which total 17,300. Okay? Now, let's go back to number 4. Number 4 says that for tax purposes, what Aspen Ridge usually does is they elect under Section 179 of the Code, of the Internal Revenue Code, to currently expense any furniture or fixtures that are purchased. And what that means is instead of depreciating the asset purchases over a number of years, which is what you would normally do for tax purposes as well as for book, there's a provision in the code, and it's under Section 179 that says, subject to some limitations, and those are usually dollar limitations on how many assets you bought, but let me just tell you that 17,300 would be below the limitation. Subject to limitations, you are allowed to deduct the entire cost of the asset purchased during the year if you elect to do so under Section 179. And you would show that on Form 4562, which is the depreciation form, which I am not making you fill out, by the way. And you would list that whole 17,300 as 179 depreciation. And that's the amount that goes on your tax return on the depreciation line. Because when you look at your 1065, oops, I didn't want you guys to see that one. That's the filled out one. Do I have a non-filled out one? Oh boy. Oh yeah, no, this is the one I did on my, it's not really filled out. This is the fake one I did on my lecture for you guys the other day. So I'm not giving away the answers. I don't want to give away the answers too easy. So when I talked to you guys over video yesterday, what I guess I just assumed you guys knew, and obviously you probably don't know, is that the amounts that go here on page 1 that add up to your ordinary business income, these are tax amounts, not book amounts. Now, some of the amounts may be the same for book and tax purposes, but where you have differences, those are called book tax differences, book-tax differences. And those book tax differences are listed on Schedule M1, which I was discussing in my video yesterday, down here. Okay? So in this reconciliation, the Schedule M1 reconciliation, you always start with your net income or loss per books. Now to get that figure, all you guys do is go back to your book income statement, and it's right here. It's already been added up for you. So your net income per books that you would start with on your 1065 Schedule M1 will be that $253,160. Now I already forgot the amount. Is it $253,160? Yeah. So then what you have to do is once you have your book amount, then you go down the whole income statement. And this is what you would do, you guys, when you're preparing a tax return. You always start with your income statement. And you say, look at all the line items on my income statement. Could any of those line items have a book tax difference? In other words, will my sales, which are $965,500 for book purposes, be different for tax purposes? They could be, and that's if, and this is beyond the scope of this class, but you could have a book tax difference associated with sales if you have multi-year contracts with your customers and you're only receiving some of the money in the current year for the contract, or you're receiving more money in the contract. Like, let's say that you have a multi-year contract with a customer, and over that 5-year period of the contract, in consideration for the customer giving you $1 million, you have to agree to maintain their software over the next 5 years for them. So they give you, I forget what I said, they give you $1,000, and over the next 5 years, you have to maintain the software that you sold to them for $1,000. So because that contract is a 5-year contract, the GAAP tells you that you don't recognize the whole $1,000 in year one. You would recognize 1/5 of it, and the other 4/5 would be recognized over the next 5 years, okay? Or the next 4 years after the first year, because it's a 5-year contract. So for book purposes, you might only have $1,000 showing in your sales line, but for tax, unless you're going to take advantage of this deferral method, which you're allowed to do, there's a whole there's a rule that says you can defer for tax purposes as well as for book, but you can only do it for 1 year. But let's say that you don't want to do that. You just want to accelerate all the sales and recognize them all in year one. That's an acceptable method of recognizing sales for tax. So then you would have $5,000, you would have $1,000 of sales for tax, but for book, you only had like $1,000 over 5 or $200, right? Well, that $800 difference is called a book tax difference, and that would go on your Schedule M1, okay? But for the purpose of this assignment, you guys only have 3 book tax differences, and I'm going to show you right now what they are. And the reason why I'm going to give you what they are in this video is because you probably would have been able to figure this out if you had read chapter 3 first and been, had learned the concepts in chapter 3, which is a corporate chapter. But now you're on chapter, 9, which is the partnership chapter, which is the chapter I would have had you read before you did this tax return, and indeed you did read it. But it doesn't talk about book tax differences in chapter 9. So I'm going to give you what your book tax differences are, okay? So I'm telling you right now, there are no book tax differences associated with sales, sales return and allowances, cost of goods sold. Your gross profit is just your sales minus your cost of goods sold and minus your sales returns and allowances. That's what that 417,600 foots to, okay? And you need all these figures because in order to fill out the tax return correctly on page 1, I'll show you what the tax return, page 1 looks like, right? You have to know what your gross receipts are, your gross sales. You have to know what your returns and allowances are, and then you subtract 1B from 1A to get 1C. And then you have to know what your cost of goods sold is, which is what you put on line 2. And then your gross profit's what you put on line 3. Now in our case, these numbers are all going to just get transferred right over to your 1065 on the lines I just showed you. Okay? Then in other income, you have different components of other income. And I am not going to all I'm going to tell you for this is I'm going to tell you that there are no book tax differences associated with either one of these items. But I'm not going to tell you where to put them on the return because that is something that you would have learned in chapter 9, is where to put those on the return. Okay, so number 1, I want to make sure you're checking your chapter, the concepts you learned in your chapter about passing through certain items on a separate basis. And when you do that, you put it on Schedule K in a separate line instead of putting it on page 1 and including it in your ordinary income. And number 2, besides looking at the chapter, I want you to look at the instructions. And the instructions have directions about what to put on almost every line of the return. And you find the instructions. I think I actually gave you the instructions in the attachments, but if you can't find them in the attachments, go into irs.gov and pull them down yourself. Okay, it's very easy. You just type in 1065 under the forms and publications link, and then all these choices will come up under 1065, and one of them will be the 1065 instructions. The student who I helped this afternoon actually printed them out. They're 50 pages long. You don't need to print them out. If you look in the table of contents, you just look under specific instructions, and those have line-by-line instructions, and just click on the link there, and it'll take you right to the page where the specific instructions start. Okay, so that's where you're going to find the answers here to your questions. Employer wages. There are no book tax differences between employer wages here and employer wages on the return. However, never mind what I was going to say. Okay, so no book tax differences. No book tax differences with regard to the interest on accounts payable, the payroll and property taxes, the supplies, the rent on the retail building. No book tax differences. Now, on the depreciation on furniture and fixtures, yes, there's a book tax difference because for book purposes, as I told you a few minutes ago, they are depreciating their fixed assets straight line over the depreciable lives, which is usually like 5 years. But for tax purposes, what we learned in instruction number 4, or note number 4 on this page down here, is that they have historically been electing to currently expense. That means take a 100% depreciation deduction in the year of purchase. So if you every year for tax purposes are taking whatever the company buys and you're currently deducting that on your tax return, you don't have anything left to depreciate from that year's fixed asset purchase in the following year, correct? Because you took all of it in the year of purchase. So that means that what is going to be the tax depreciation expense on this return for Aspen Ridge? $17,300, because everything else, all of the depreciation on the prior year fixed asset purchases was already taken on the prior year returns in the year of the asset purchase. And that was pursuant to the provision in Section 179 of the Code. Okay? So you will therefore have $17,300 of tax depreciation expense, which is going to go right here on line 16A. Okay? You don't have anything to put on 16B, so don't worry. So 16C and 16A are going to be $17,300. Okay? Now, going back to our reconciliation, our Schedule M1 reconciliation. You started with $253,160 of book net income. For book purposes, we took depreciation of $45.50, correct? We have to disallow that. We have to add it back to the book income number. So in other words, we're going to disallow the book depreciation and we're going to take depreciation for tax purposes of $17,300. Okay? So you're going to have excess tax depreciation over book depreciation to the tune of whatever the difference between $17,300 and $45.50 is. So if those were your only book tax differences, then you would have taxable income of $253,160 plus $45.50 minus $17,300. And whatever that amount is, whatever that comes to, that would be your tax income, or it could be loss. But in this case, it would be income, right? Because you're starting with book income of $253,000, and then you're adding back $45.50, so that's going to be, now you're up to like $259,000, and then you're going to subtract from that $17.3, so you're going to be down to like $242,000. So rounded, I want you to put in the real numbers, but rounded, it'll be around 242. However, you do have two other book tax differences, and I'm going to tell you what those are right now. So we've determined that we do have a book tax difference associated with the $45.50 of depreciation, right? And I just told you how to calculate that. You also have a book tax difference with regard to the meals and entertainment. And that's because, and you would have learned this in chapter 3, if I had you do that chapter first, and next semester I will be, so don't worry. You would have learned that meals and entertainment expenses are only 50% deductible for tax purposes. So what you guys should know is, and I told the student this afternoon, is when you're doing a business tax return, there's a concept of having a book income statement in front of you, and then you are applying book tax differences to those items in the book income statement to come up with a tax income statement. The tax income statement is what goes on your tax return. Now, the lines that you put the different items included in your tax income statement will vary sometimes from the way those items are described in your book income statement. So you might be combining 3 rows from your book income statement, and you would put them on one line of the tax return. But what's important to note is that you have a book income statement and a tax income statement. And it's the tax income statement that you're putting on the tax return in some fashion, right? And in the case of a partnership return, you put some of that tax income statement on page 1, and you put some of it on Schedule K. Because some of the items included in your tax income statement need to be passed through separately to the partners. Because you learned that in Chapter 9. And that's because they could be treated differently on a corporate partner's return than they would be on an individual partner's return. That's the whole reason for passing through certain items like interest income separately on Schedule K. Okay? Otherwise, you could end up not having the tax rules in the code applied correctly to a corporate partner versus an individual partner. So you will have a book tax difference equal to 50% of this amount. So 50% of that is $11.20, and that equals your M1 adjustment. Okay, that's your book tax difference. And also, because it's 50%, your tax, meals, and entertainment expense is equal to $11.20 also. So what happens with the M1 adjustment? Well, it goes back on Schedule M1. And there's a nice little line for it right here. Remember, these were examples I gave you the other day, so you can ignore these. I'm putting in real numbers right now for you. I'm just the nicest person ever. But I really need to, you guys, because I failed you in that I scrambled the chapters, and I shouldn't have scrambled the chapters. It's just not a good idea to have done that. You really don't have any book tax differences associated with any of this stuff. I was just giving you examples yesterday. So now you have one more book tax difference that we have to figure out. And the last one is, let's go back to the stuff. The last one is talked about up here somewhere. Where is it? Here it is. They tell you in the facts, in the notes, that included in miscellaneous expense is a $900 expense for a fine that was paid to the government for violating a local signage ordinance. And I will tell you that penalties paid to the government, any government, are non-deductible on a tax return. Okay? So they would be expensed on the book income statement, but you need to add them back for tax purposes. And tax practitioners, we call it an add back. It's really a disallowance, right? If it's an expense, what I mean when I say add it back is we're basically crediting the expense, because an expense normally is a debit, correct? On your income statement, expenses are debits and income are credits. And if you have credits in excess of debits, you'll have net income. If you have debits in excess of credits, you'll have a net loss. So when I say add back, I just mean disallow. So if we go back up to the miscellaneous expenses, you'll see that they total $57.50. But I just told you that you now need to add back the $900 of penalties. And so the amount you're going to actually deduct is $48.50. Okay, that's going to be your tax miscellaneous expense. Now, I'm going to make you figure out what line of the return to put it on, but I did give you what the M1 is. And now, where does that 900 M1 go? Well, I'll show you. Oh, uh-oh. Okay. Sometimes I press the wrong button and I didn't mean to. Okay, let's go back to, here we go. So penalties go, they are expenses recorded on the book, not included on Schedule K. Okay, so that means if you have an expense that's recorded on the books that's not included in your return, then you put it over here on line 4. Now, I can't put it on 4A because that's already relegated to depreciation. I can't put it on the meals and entertainment line. Oops, this should have gone here, sorry. Because I already used my meals and entertainment line for something else. If you were doing this return in software, you would actually have a C statement whatever typed in right underneath line 4B, and it would say C statement 1, for instance, and when you go to statement 1, it would have that $900 penalty. So what I want you to do here is I want you to add $45.50, $11.20, and $900 and put your answer right here, okay? That's what goes on line right over here, okay? I'm not going to add it up right now. It's like 50, well, maybe 5670 plus 900 is 6570. Check my math, obviously, but I think that's what's going to go there. And what I did when I did the tax return by hand last semester was I typed it somewhere. I don't know, I can't seem to be typing this, but I know I typed it somewhere. Like I put penalty, C statement, whatever, something like that. You don't need to do that. I will know that the penalties are included in there, okay? Or if you wanted, you could put it over here, but this is actually incorrect. Because if you put it over here, you have to put minus 900, because these are all subtractions from net income. So you'd have to make the penalties a negative number in order to make it come out right. I don't really want you to do that. I want you to put it on the correct side of your M1. So that's your Schedule M1 schedule. I'm going to ask you guys to foot it and add everything up, right? I gave you all the answers. And then just know that everything else in your book income statement is going to be the same on the tax return. These are all of your M1s, okay? So for tax, it equals 17.3, okay? I hope this helps you guys, and I want to stress to you that I want you to read the instructions for everything else. The instructions and Chapter 9 applicable pages. If you're not sure where to put a certain item on here, read it in the instructions. It will tell you. If you don't find a line for supplies, it's probably because they're because it's going to go on a miscellaneous hint line, right? And some of these other items aren't found on page 1 either. So if you have a whole bunch of items that go on the same line, add them all together and put them on the same line. But you need to check your instructions first to make sure you get stuff pocketed correctly. That's very important when you're preparing a tax return, to get the stuff on the correct line. And that's because if you were audited by the IRS, they would come back to you and possibly say, hey, you have a whole bunch of, you have like $1 million sitting on your depreciation line, but if I look on your Form 4562 or on your balance sheet, you only have $500,000 worth of fixed assets. How could you have $1 million worth of depreciation? And you might come back and go, oh, well, my staff person put some other expenses on the depreciation line by accident. Well, now you're being audited by the IRS because you put some wrong expense items on the wrong line, right? So that's why it's important to pocket your stuff, classify your stuff on the correct lines of the tax return. Hope this helps. Good luck with everything. Talk to you soon.